You know, the Fed is tremendously concerned, Janet Yellen is, about inequality, income inequality, Michael, and also obviously employment, and she has clearly been, and they have been very reluctant to rock the boat at all in what they must consider to be the fragile world order. They've been looking at the volatility in the markets over various periods, and also the fragility of the U.S. economy. So how does the Fed, do you have any sense of how the Fed factors in what's this election landscape?
I think they're mostly and rightfully ignoring the election landscape, right? What the Fed's worried about right now is when long-term interest rates are a good indicator of future growth rates. And if you look at long-term growth rates right now and where it looks like GDP would be growing, you know, instead of growing at, you know, let's say an average of 2%, you're talking about an average of 1%. And that 2% is even sort of low, but the difference between 1% and 2%, you know, it's double. And where the big difference lies, if you think about this, at 2% growth, per capita GDP, or let's say the quality of life, doubles every generation. At 1%, it doubles once every 75 years or so. So the Fed is sitting down and looking at you know, that is not what America's used to. America's not used to the quality of life taking twice as long to double. No. So they're looking at what's causing that. How could we possibly fix that? And I think they are starting to pay more attention to some of these, I guess you could call them social economic indicators. And that is certainly something they're looking at and something that is weighing down that potential long-term growth.
So a December Fed rate hike?
Well, the Fed, I mean, barring some sort of bizarre curveball, the Fed's going to raise rates in December. But what happens in December doesn't matter. There's really no correlation between markets and what the Fed, a single rate hike. What matters is how what the Fed signals are going to do in the future. It's the path. If the Fed signals that they're going to move a lot more than people had anticipated, then you see the markets move. But that is pretty unlikely. I mean, the Fed raising rates, it's going to be glacial. I think Jason had mentioned it earlier, and I think that's accurate.
Right, but they've all been made T-shirts about raising rates in December, and flown planes advertising like they're going to. Central banks
globally have done pretty much everything they could do, and it's really coming down to the fiscal side. If you know, to reinvigorate the economy, what you need is to bring back animal spirits. You need to give people a reason to invest their money, and without that, you're going to see this long-term, really low potential growth rate. Suddenly, if companies have a reason to make capital investment, if they have a reason to expand, if they have a reason to be optimistic, you'll see all this cheap money being used, and you'll see the potential growth rate go up. But until we see that, we're going to get more of this.
So, you know, and I'm going to get to your questions in just a minute, but given the, you know, what we know about the platforms, the economic platforms of the two candidates, which candidate is most likely to provide that stimulus?
I mean, you know.
So tax cuts have worked in the past. That's
well.
Donald
So
Trump.
if you look at the empirical evidence, tax cuts do work to help stimulate growth, but government spending actually works a little bit better. So you know, I think any type of plan that's going to increase infrastructure spending, but you know, we're talking about very broad aggregate spending. It needs to be smart. I think, you know, the fiscal stimulus policy that was implemented several years ago just wasn't smart, and it's very hard with the way Congress is today to implement. What do I mean by smart? Things that really increase productivity, right? We're an information economy now. Back, you know, when they built the highways, we were manufacturing. So the highways made sense. It helped get goods, material to different places. We're now a data-driven economy. Like, why doesn't everybody, if you're going to spend $1 trillion, why doesn't everyone have access to internet, right? If you're in a city, you should be guaranteed some minimum level. Things like this would actually do a lot to increase long-term productivity, which is what's going to get that growth rate up. Not digging holes and refilling, you know, holes in the ground and refilling them. Of course, you know, some infrastructure needs to be fixed, but we need to think about what is today's economy and how do we maximize that.
But it's ironic that in the with the paucity of economic discussion we've had in this campaign, both candidates have embraced infrastructure,
yes,
slightly differently in their models, but they've both done it, which I thought was really impressive. Remember, I'm Canadian. We tried the corporate tax to 15% in Canada. It's not a bad thing at all. It just doesn't give you the same juice that Reagan-style tax cuts did. And the Trump campaign for several weeks ago glommed onto this idea that we're going to compare Obama's era to Ronald Reagan's era, which for a lot of reasons isn't useful. They didn't have the internet then either. But just the sheer volume, when you're talking about personal tax cuts, we just don't have as much space to create the stimulus that we'd expect out of that. When you're going from 39.6% on a marginal tax rate to 35-ish, the impact is not the same as when you're going from 70% to 40%.
Here's a question from the audience. Who would a President Clinton or President Trump pick as a Secretary of the Treasury? Is an ex-Wall Streeter possible? Anyone want to go ahead?
I have no insight or knowledge as to what you might do, but I was thinking about that Silicon Valley connection, and maybe it's Sheryl Sandberg that worked for Larry Summers, or somebody out of the technology world where you could apply some of those skills to, or at least have the optics of applying some of those skills to an economy that needs a jumpstart.
I'm not sure she's demonstrated a whole lot of out of the box after Tim Kaine. I'm not sure I'm holding out a lot of hope for that sort of thing. I'm actually of the camp that she might keep 3 cabinet secretaries around, and Jacob Lew might not be a bad idea. Donald Trump has signaled that he will. It's sort of in recognition of the relationship that he'd like people to think that he has with Wall Street, he's signaled that it might be a banker.
Right. Which leads me to another question, which I didn't ask any of you, and I don't know if it was brought up with Jason and Nick. And that is, what do you think the investment reaction will be if to a Democratic sweep versus a split Congress? I mean, that the House wins, the Republicans win the House again, the Senate turns Democratic. Is that going to make a big difference? Have you factored that in?
I think a Democratic sweep that gets to the House, which is unlikely at this point, but if it did it, I think Jason or Nick brought it up, that would cause it might cause a bit of a negative market reaction because heavily regulated industries would then have to take a look at how they might not profit.
Agreed. Yeah, agree with that.
And a question from the audience was, even if there is a violent market reaction, it didn't necessarily say to that scenario, and increased volatility as a consequence of the election results, whatever they may be, isn't the volatility likely to be short-lived?
Depends if Donald Trump accepts the results of the election.
I mean, I think, yeah, if the volatility is due to Trump accidentally instigating some sort of trade war, well, that's a problem. But if it's just a knee-jerk reaction to him winning the election, I think that, like Brexit, it would be relatively short-lived.
Right. I think it's one of those, hate to say it, news cliches. Time will tell. Back to you in the studio, Consuelo.
What is your opinion of the Fed keeping rates low to maintain growth, that's in quotes, for the sake of political gain?
I mean, at some point they're losing. It's kind of like they're losing all their friends in doing it. So I'm not sure that the growth is coming. This idea of income inequality is getting exacerbated by it. So I don't know that they gain anything by continuing down this path. I think they've got to show us a chart indicating increased interest rates.
And Mindy Ross, I don't know if she was introduced by David, who organized this entire evening, came up with some of most of the agenda, and I want to ask a question that she brought up in organizing this evening, and that's money flows. And so, what are each of you seeing as far as the money flows pre-election, and what are the predictions of what you're going to see as far as where investors are going to be investing post-election?
Sure. Well, there has been money outflows, certainly from mutual funds and ETFs and ETPs in the last few weeks, the last few months. I think that's the trend. And I think that's people maybe putting their hands in their pockets to wait this out. So it hasn't been extraordinary, but it has been a trend. So if you just look at where investors have been putting their money and where they've been taking it out and taking chips off the table, that's certainly been happening. When they put it back in, I think, November 9th, we'll have a better idea. But you have seen a steady, I wouldn't call it, I would just take it a steady removal of money from those products in particular.
It's not, this is anecdotal, but the one interesting thing about Donald Trump is he has got a recipe for repatriation of capital, and it would be interesting to see if that was successful. Hillary Clinton hasn't spoken much about that. She doesn't really see it as the issue that he does. In Donald Trump's world, if you get all that, if you get corporate money that's not sitting in America into America, it will, that's I think where he gets his 4% growth number. I don't think the math works, but it is interesting that Hillary Clinton's not looking at that, and that will continue to be a challenge for the next president if we keep having inversions.
And do you have a sense, again, from your overseas sources as to what the financial reaction would be as far as their view of America as a place to invest, depending upon the election outcome?
Right. So there's not much that makes America a bad place to invest, given the state of the rest of the world. You'll notice that no matter what happens, we end up being stable. Even when people threaten to not pay, make debt payments, it doesn't tend to affect our bonds too much. I will say that one of the points that Michael made about China and TPP is interesting, that there are people who invest in America because it's hard currency. China is working hard to become that. And if America pulls out of TPP and our Asian allies have no choice but to deal with China, then Chinese investments become a lot more significant.
Which is what Michael was mentioning.
Yeah.
Michael, do you want to elaborate on that at all?
Oh, I'll answer the original question.
All
I
right.
mean, you know, on the China thing, one of the telling signs about how our allies are looking at China now, the Asian Infrastructure Investment Bank, when they were going to fund the bank, China went around the world to try to raise funds, and the U.S. refused to sign on, but pretty much everyone else did. And that's already, you know, a sign of cracks that are forming. If you look what's happening in the Philippines right now, that's a bit of an extreme example, but the cracks are forming there. This is the beginning. This is China expanding its influence in Asia and here. I think Canada might have even signed on to the Asian Infrastructure Bank. Imagine that. Yep. And I actually met the head of the Asian Infrastructure Bank recently, and he's an amazing speaker. He was fantastic. He really outlined a really good vision. So if you ever have an opportunity to hear from him, he's a very compelling speaker. But on your question, I think, you know, Jason and Nick gave some good sector-specific plays, I think,
right,
for election results. I think you've got to put the election aside for a minute and look at the U.S. economy. You know, we've had a lot of false starts in terms of thinking we're finally in a period of sustainable economic growth. This time there's a major difference, and that is that we are probably at or very close to full employment, meaning the point at which that all of the people who lost their jobs during the Great Recession, who are now trying to find jobs, have that. Maybe not necessarily the jobs they want, but we're at a point where you're going to start seeing wage pressure build. We're already seeing wages going up. And as wages go up, people buy more stuff. Inflation goes up. So this is going to help justify the Fed to increase interest rates. And this is quite good for risk assets, potentially. And, you know, another interesting concept is we've seen no productivity growth in the U.S. or many other countries. It's been a big conundrum. Well, think about it. If you don't have companies willing to invest, make capital investments, right? You know, invest in a new $100 million machine that's going to run your warehouse, you're not going to have those investments, especially while labor's cheap. If labor's cheap and you're not confident in the future, you know, go hire some people that you could fire later. You're not going to make that $100 million investment. Suddenly, as wage pressures start going up, incomes start going up, companies are going to start making those investments. And then, you know, that's going to be another boost for the economy. And then also, of course, you'll see productivity go up. So we could be at the beginning of a somewhat virtuous cycle, with the big caveat being, if for whatever reason we start seeing employment growth drop off, or anything that's going to impact income growth suddenly appear, you know, we could go back into recession. But right now, the signs are pointing in the right direction.
I think we're going to leave it there. So, and David, I know you're coming up to wrap this up, but I just want to thank our panelists so much for participating.
My pleasure.
And for your insights from very different perspectives. It's great.